Sorry, Pickerel.
Good morning.
We were on another Zoom. We were on a Zoom test a minute ago.
Oh, woman. I was so nervous.
What?
I was so nervous.
I know. Okay.
Do I sound okay?
Yeah. I'm going to try to.
And actually, I looked okay.
Hold on just a second. I need to share something. Do I not have it up? There. Do you all see the
Yes.
slide? Yeah?
Yes. Looks a lot better than what I have.
I'm going to start letting people in then.
I can let him in, Cassie.
Okay.
We don't have anybody, do we?
Yeah, there's somebody waiting.
I don't see it.
Oh, I don't have you set up yet. Hold on.
I don't see anybody. Oh, I can't see it because I'm not. Okay. Are you doing this one instead of Soraya?
Yeah.
I just left you a voice message because I couldn't find out how to get on, but I went back to the 18th and found it.
I'm not showing my participant. Oh, there they are. Okay. I'm going to make you a host.
Make me a co-host.
Yep. And hey, Stephen, who's doing, who's sharing screen? Are you sharing the screen?
Yeah, I will be.
I'll make you one too. Okay. You're a co-host, so now you can share. Bear with me. I'm not usually the driver on these.
I don't know who this.
Morning, Doug.
I don't know who FF19322 is, but.
Well, in just a second, they will have their audio fixed and you can ask them. Can you let us know who you are, FF19322? Oh, it's still connecting to audio. Never mind. You cannot hear me yet.
Are you going to ask everybody to change their thing?
Yeah, I will. There's not going to be very many people. I think there's only like 7 besides the PNC people and KLC people. So hopefully we can get them all. Pickerel, you want this to just kind of be, are you going to do, you're doing a presentation, right?
Yeah, I'll just have a slide or slideshow from my side. And then we'll have PNC being panelists.
Okay. Do you want to answer questions along the way or do you want to wait until the end?
We'll do, because it's such a small group, we'll be able to field questions as they arise, or if anybody wants to hold till the end, I'll just monitor the chat box or the
so you'll monitor it to do. Okay, sounds good to me.
I'll let y'all blend into the background.
Can't do the teams, just don't worry.
Because we got off this last test and I didn't have time to run to the restroom. So I will absolutely let you monitor everything after we get this started. Okay, FF19322, who are you?
Okay, hi, I'm with PNC.
Oh, okay.
I guess starting up pretty shortly. How are you all doing?
We're great. Will you do me a favor and change your name?
Do you know how to do that, or?
Yeah, just go to participants. If you toggle over the screen, it should be at the bottom.
Okay, got it.
just do participants, and then if you click more, it'll say rename.
Got it. Okay.
That way everybody knows who you are too.
That's my middle name. Okay.
Do I need to make anybody else a co-host to share anything, Pickerel?
No, it'll just be from
Steven?
our side.
Okay.
Hey, good morning, everybody.
Good morning, Steven.
How you doing?
Good. Let me just mute my TV. There we go. How's everyone doing?
Good.
Amazing.
Beautiful, hot, humid summer day, the end of August. What more could you ask for?
Exactly. It's a hot one today. Yes. This is my first Zoom experience, believe it or not. So I just wanted to log on early, make sure I had no issues, because nothing seems to go right for me, especially if I wait till the last minute. So I figure at least if something goes wrong, I got a good 5-10 minutes to resolve things.
Well, we can hear you, we can see you, so that you've
All
won the game.
right.
We hereby designate you a Zoom professional.
Well, I'm good enough to click on the link. I don't know if I could set up the link and do all that fun stuff, but
Who should I turn it over to? Should I turn it over to Karski or Doug? Doug?
Doug.
Okay.
Morning, Mark.
Hey, good morning.
Oh, no.
Good morning. All right. Good morning. Can you hear me?
Yes, I can hear you. I had to unmute myself.
Okay, I will mute myself back, okay?
It's good to see you, Mayor.
Yeah, sorry, I did not mute everybody, but somehow it muted everybody.
Oh, yeah.
Whoever keeps muting all, please don't.
It's not me, Cassie. I don't know.
Karski, is that you?
The one time.
Uh,
I like power. I can't help it.
You want to unmute all?
Well, I think we'll still keep it kind of quiet until we hit 10. I know we're still waiting a few more participants and a few more representatives from PNC. So enjoy the silence of a Tuesday morning.
That's right. All right, it is 10 o'clock. Hello, everyone. I'm Cassie Cooper, and I'm just going to give you all about 2 housekeeping items. I think we have almost everybody's name on here, but I see like one that's an FF 8922. If everybody can just take a moment and rename yourself, you just toggle over the screen, you'll see participants at the bottom. Just click on participants. Your name will be at the top. If you will just toggle over your name, click more, and then rename, and name yourself your first and your last name with your city. That will help us out tremendously. Also, they have informed me that they will answer questions along the way. So if you all have any questions, just use the chat function. And Stephen Pekarsky is going to monitor that for us, and so you can just put your questions in the chat box. Other than that, just stay muted if you're not talking, so we don't hear the dogs barking or the people coming in City Hall or whatever else is going on. And I'm going to go ahead and turn it over to Doug Goforth to get us started. Thanks for being here, guys.
Thanks, Cassie. And good morning and welcome. My name is Doug Goforth. I'm the Deputy Executive Director here at KLC, and thank you for spending your Tuesday morning here with us. And I think it's kind of good timing when KLC got legislation passed and went through setting up an investment pool and selecting a partner with that, which is PNC Investments. Especially with what's going on today with money market returns and things. It looks like there's not necessarily a safe place, but we've got a lot of options that the team's going to talk about today. And so I think you'll find it very interesting, and we definitely appreciate your time today. Also on the call, we have our KLC president, Mayor Bill Dure from Jeffersontown, as well as the mayor of Southgate and the president of the investment pool, Mayor James Hamburg. So along with Stephen Pekarsky and here at KLC and our group from PNC, and I'll let all of them introduce themselves. But feel free to ask questions, as Cassie said earlier, and hope you have a good call. With that, Stephen, I'll turn it over to you.
Thank you, Doug. Good morning, everyone again. Welcome to today's webinar. I am Stephen Pekarsky. As Doug mentioned, I along with Robin Miller, are your program administrators for the investment pool. Obviously, with the passing of House Bill 69 last year, KLC recognized the great opportunity this presented our cities. So the revision to the existing policy to allow for the inclusion of exchange traded funds, individual securities, and high quality corporate bonds presents our cities the potential of an expansion of revenue streams. Today's webinar session is going to be a little more informal and smaller in nature. Our hopes are that we've created an environment that will allow you to ask questions as they arise in an environment that you feel comfortable. We hope for today to both address the unique challenges and opportunities as presented with today's realities of our current environment. With the KLC investment pool, we have created the opportunity for you all to use our economies of scale, similar to what we've done with our insurance and finance programs. Along with KLC today, we have our partners from PNC's Institutional Asset Management Group to cover both the structure and the challenges that we've alluded to earlier. As Cassie had mentioned in the beginning, this is an opportunity to ask questions as they arise. If you don't feel comfortable asking those questions, please feel free to enter your questions into the chat box, and we can either address those as they arise, or we can save them at the end of our program to have a nice Q&A session. With that being said, I will turn the platform over to the stars of our program today, PNC. Bill, you have the stage.
Great, thanks, Stephen and Doug. Can you guys hear me okay? Just give me a thumbs up.
Yes,
All right, great. Wonderful, thanks for getting together today. We wanted to take a moment during a time of unprecedented events happening that are affecting the investment options that cities have to talk about the pools. And we know we've got some new people in the KLC, and we've got some interest in the pools. We want to highlight some of the features and benefits of what's out there and what's available to cities. And in particular, as Doug mentioned, the low interest rate environment is making things a little more challenging in terms of what do you do with that idle cash. And we've got some options today that we think will be really interesting if you haven't heard about them, and maybe even more interesting if you've participated in some of the events that we've had over the past year where we've talked about the pools. And just a quick introduction of the group, and we can get right into it. But first of all, my name is Bill Seifert. I manage the institutional investment group in the state of Kentucky. With me is Kevin Blair, who is our business development officer, and also Mark Snyder, who is our senior investment advisor. And Mark works directly with cities in structuring allocations into the pool and all the mechanics of how to get in and how to participate. And also with us is our equity team led by Doug Roman and his analysts Mark Batty and Steve Baumgardner. And these gentlemen manage the dividend focus strategy, which is one of the options that we'll talk about today in the investment pools. And dividend stocks that are high quality and are increasing their dividend payouts are one of the things we wanted to make available to cities. It's one of the investment options because there is such a challenging environment in conventional ways to invest money in CDs, even in bonds and treasury investments. So today we're going to walk through some of the particulars of the pool, and we'll spend some extra time on the dividend focused strategy, and hopefully we'll have a lot of questions from cities out there. But with that, let me turn it over to Mark Snyder, who's going to guide us through some of the particulars of the investment pool program. Mark, are you out there?
Yes. Thanks so much, Bill. Hopefully everyone can hear me. Stephen, if you go to the first page there. Good morning, everyone. And it's a pleasure to be here with you today. And what I wanted to do is really to provide a high-level overview of the investment program that we've kind of set the stage for with Doug and Bill and Stephen have mentioned already, and with that highlight. And really, I think from my perspective, when any investor goes to start an investment program and to look into what's really important and what they need, I think there's a few key components that you always want to look for that you have, and that is flexibility, efficiency, and transparency. I think if you have those kind of ingredients within an investment program, it really sets you off on a good path for success. In regards to flexibility, we have developed a unitized investment program. It allows you to structure an investment program specifically to meet your needs, whether you're establishing more of a bucket strategy of looking at the time horizon of your funds with short-term money, kind of medium-term money, and long-term money, and developing a strategy for each one of those buckets and establishing a policy in those regards. And that type of structure may be more important today more than ever, given the fact that your short bucket, it really has no opportunity for any material earnings whatsoever. There's no lockup period within the flexibility. So it gives you the opportunity to move money in and out as needed. And all of the funds are valued on a daily basis, just like you're buying a mutual fund or something like that. So it gives you the flexibility to maneuver around as your needs change, because that's the one thing we can always count on is that and be prepared for is change. And you can open up as many sub-accounts as you need. So that also helps with your structure and looking at how you want to account for the money, whether it's a specific road fund or a general fund or long-term rainy day fund, whatever the case may be, you can establish an account, and each one of those accounts can have a different asset allocation to best meet your objectives. So that kind of covers the flexibility of the program at a very high level. The next thing is efficiency. You want to make sure that you're managing money in a very low cost. What Doug mentioned before is you take advantage of the economy of the scale of investing money with cities just like yourselves across the state in large pools of money. So you can manage money efficiently. There's no cost whatsoever to open an account within the program. So you can have it started and you can have it available as your needs change or you need an opportunity, you can immediately utilize those funds to invest that money. There's no minimum investment. So you can invest a small amount of money in a large established pool to give you broad diversification. And we have very low management costs for the entire program. And it's currently at 35 basis points, which is around 1/3 of 1% based on the assets that are invested in the program. And then transparency is very important. And so in order to do that, we provide monthly statements. We would also provide the city administrators with online access to your funds. So you always know what's going on. And you also have our team here in Louisville as resources to help you with that. Again, this is your program. This is the program that we've built along with the Kentucky League of Cities, establishing it, provide the functionality that we believe cities need. And as we learn more and continue to develop and hear from the cities, we'll add additional investment options, just like we did with the dividend-focused fund back in December of 2019, after talking with the cities and seeing that the needs and people really like the opportunity to get a nice income stream off of their portfolios. Going over to the next page there, we'll provide a very quick overview of the investment options that we've just discovered. As I mentioned, they're unitized pools. We have 5 investment options currently. The first one for your very short bucket of money would be the money market fund. Obviously, and this is the only pool that has a stable value of $1 per share. So it's just like a savings account. And in this current environment, we're not really recommending the utilizing of the money market fund because the yield is about 6 basis points and net of fee, you would have a negative earnings. And so we're not recommending that fund, although we're keeping it open so that when rates do rise, it can be another option for your short-term money. Again, this program should be used as a complement to your existing program, in our opinion. You still have your short money with your CDs, your money market accounts, your operating accounts at your local bank, and then utilize the pool as a complement to maybe the medium term, longer term money, that type of thing. The next pool is the government bond fund. And you can invest 100% of your investable assets in the government bond fund and also the money market fund. The government bond fund is obviously invested in 100% government bonds and treasury notes. And their objective there is to provide a predictable income stream, preserve the capital that's invested, and mitigate interest rate risk. And I'll go into a little more detail on that in just a moment, how we go about doing that. The newer funds since the House Bill 69 was passed a year ago, would be the next three options. The corporate bond fund, which has now been established, and can invest in high quality individual corporate bonds. And given the way the law is structured, you really need, if you want to invest in corporate bonds, you have to invest in individual corporate bonds. It has to be, the bonds have to be rated A or better and have a maturity of no less than, or no more than 10 years. And that, in order to meet those requirements within the law, we could not find a mutual fund or an ETF that met all those requirements, because investment grade bonds go down to BBB. So this is a higher quality even than investment grade, the highest quality. And we've managed, now that we have enough capital, established a pool that I think could be very beneficial to cities to pick up additional yield and growth over time. And I'll dip into that more in a minute. And the other two options are the equity options. Excuse me. And really, you can utilize these to control your exposure to the equity markets. Again, given the law within House Bill 69, you can only invest in companies that are included in the S&P 500 index. So we have the S&P 500 index fund, give you broad equity exposure to the large cap equity market. And we also have the dividend focused fund that is individually managed portfolio of around 62 holdings. And it's managed by our team that's on the phone that we'll get in more detail here later as a long-term track record. It invests in companies that are growing with growing income streams, attractive dividend yields, and positioned for positive earnings surprises. And again, looking at the fundamentals of the companies and provide superior long-term performance with a higher income stream to meet your needs. Going over to the next page there, I want to dip in just for a moment on our fixed income funds, the government bond fund and the corporate bond fund, as I mentioned. These are managed by our PNC fixed income team with our quality income strategies that meet perfectly the requirements of the law and what we believe that the cities are really looking for. Again, the objectives of both of these funds are to provide a predictable income stream, to preserve the principal of the capital that's invested in those funds, the city dollars, and to mitigate interest rate risk within those funds. And we do this by using a laddered approach in managing these funds. So we look through the short to intermediate type of curve and develop a ladder. So we're investing in bonds throughout 1 year, 2 years, out to 10 years. And you invest in a pool of those. So you're not, when you invest in these funds, you're already investing in a diversified pool of securities along with all the other cities that are invested in these funds. The government bond fund currently is around $9 million in total, and the corporate bond fund is around $3 million. And so they have been established, and as bonds mature, then you take those maturities and you go out to the next longest tier and you develop your ladder, so that in a typical market with an upward sloping yield curve, you're constantly reinvesting dollars at higher yields. So really, the portfolio is managed for you. There isn't a term structure. There's no lockup period like a CD. So you're getting the flexibility and management of those funds to protect that principal, increase the income that's poured off, and mitigate that interest rate risk by continuing to invest out that ladder. We have a team that looks at looks at each individual security. Especially on the corporate bond side, we're investing in the top tier of quality, which I'll show you in a second. And also, every time you invest in these pools, you're invested in compliance with the House Bill 69 and the Kentucky law. Going over to the next page gives you kind of a snapshot quickly at the top of performance for these pools have been around for 1 year, except for the dividend focused fund that was opened in December of last year. So everything else was open really kind of towards the end of July of 2019. And I think it's important, when cities looking at these funds, it's a different strategy. It's a different approach than just investing in CDs, money market funds, and things like that. So really in CDs, you know, you think you're not losing money, but in real terms, you are losing money. Factoring in inflation, and especially in these low interest rates, you're not keeping up with that, and the purchasing power of the city's underlying funds are going down. So that's where I think you can start to look at more of a long-term approach and look at the time horizon of the various buckets of money that you may have and structure a specific program to meet those needs. It's amazing to think of what we've been through this last year since the pools have been established, and how the economy was, you know, chugging along at the end of the year, and then the wheels fell off. We hit the stop button in March when the coronavirus. Then we had the oil issues and things like that at the same time, and now we've had a rebound, a significant rebound, and so for the people who got in the cities who got in the fund, and say the S&P 500 equity fund, when it was established, they've earned 11.5% on those long-term dollars. Amazing to think of where we've been to, and a positive return year to date. The corporate bond fund is just, like I said, we needed individual securities to meet the requirements of the law. And so we really utilized a prime money market fund for basically the entire year until we had, received enough capital to properly diversify the holdings. And so if you look down at the bottom of that page, you'll see the current holdings of the corporate bond fund. And those are going to be companies that you very well know. The mega cap companies, several of them are the top 5, which basically currently now 5 companies make up over 20% of the S&P 500. And several of those companies are recognized here with Apple and Microsoft, those types of companies. But high quality companies, we're investing, in a laddered approach at different maturities. So when we invest in the corporate bond fund, those are the companies that you're investing in, and really you're investing them to pick up additional yield. So it's currently yield to maturity of around 78 basis points. And you compare that to a yield that you're getting, in a money market fund at say 6 basis points, or the government bond fund around 28 to 30 basis points. And there's also an opportunity for principal appreciation over time. And so, that's again, the diversification and the opportunity that you have to efficiently invest in all of these various pools. Going over to the next page, we'll show you just really just take a quick glance where you all know where we are with interest rates. Really, the Fed took unprecedented steps in March to stabilize the fixed income markets and did a tremendous job. And now they have set the Fed funds rate at basically 0. And Chairman Powell has noted there at the top, has even come out that their committee is not even thinking about raising rates. So we're going to be in this low interest rate environment for a while. And so as you know, if you've had CDs coming due, over kind of some ranges there, the CDs, marketable CDs that we're seeing in the marketplace, the yields are not attractive. Money market funds, the same type of thing. You look at the government yield curve at 68 basis points currently for a 10-year yield. So that's really kind of anomaly in the market currently, and we'll work out of this, but it's going to take some time. So that's where I think you're going to need some flexibility and really some, look at pools a little differently. If you truly have some longer term money, say 3 years plus, look at that money a little differently. Set that aside, establish a different type of policy or approach for that, so that you can earn money on those funds and overall maintain the purchasing power of the city's dollars. So that's where diversification is key, and give you those opportunities. Over on the next page, this is a good point where I'm going to turn it over to Doug Roman, who is the managing director of our Advantage Equity team, and to give you take a few minutes to discuss the dividend-focused team and the fund, the equity markets, what they're seeing, and that type of thing. So I'm going to pause for a moment and turn it over to Doug Roman.
Thank you, Mark. Can everybody hear me?
Yeah.
All right, very good. Thank you. Yes, hi, I'm Doug Roman here. I'm Managing Director of Equities for the Advantage Portfolio team. I'm here with Steve Baumgartner and Mark Batty, who are also portfolio managers for the dividend-focused product. I'm just going to talk a little bit about the environment right now for dividend-paying stocks, and we'll hand over to Steve and then Mark. But you can see by this graphic that stocks as a source of income, it's really been unprecedented. You have to go back to 1950s to have a period of time when when stocks as a source of income have been this more attractive than the alternative fixed income asset classes. You can look at this graphic versus that of for treasuries, but even if you look at corporate bonds, as we went through earlier when Mark was discussing the different options, the dividend-focused portfolio with a 2.7 yield is well above that of corporate bond, 10-year corporate bonds, and even 30-year treasuries. And another thing to stress, I think, with this portfolio is a lot of dividend-oriented equity products. They're essentially investing in higher yielding parts of the market, and they're more really a credit play. They're looking to make sure your analysis is looking to see if this company is able to maintain this current dividend with a higher payout ratio and a higher yield. That's not the type of stocks which go in the dividend-focused portfolio. These are high-quality stocks which have a long history of increasing their dividend payments over time. And so they have more reasonable payout ratios and higher quality, less risk. And this is a very interesting environment too, and not only that in terms of the relative yield of the dividend-focused portfolio and stocks in general versus fixed income. But it's an interesting that if you look at some of the holdings that are in the dividend-focused portfolio, and I'm going to even say most of the holdings within the dividend portfolio, the stocks actually have a higher yield than the underlying credit, like a 10-year debt. That includes Home Depot, Pfizer, Procter & Gamble, Philip Morris, and Honeywell, our newest entry to the Dow Jones Industrial Index. All have their stocks all yield higher than their 10-year corporate debt. And we're in an environment also where stocks overall, again, are more attractive than fixed income. You're almost 50% of the S&P 500 now has a yield above that of the 10-year Treasury. The long-term average is less than 10%, about 9.4. So we're in, because of the Fed actions and the overall environment, low interest rate environment, a period where stocks are more attractive than bonds as a source of income. And another thing with these portfolios, again, we're talking about companies which are dividend growers. Historically, the S&P earning dividends have grown at a 7% rate, around 7% rate. And so that 2.7 you get in the dividend focus, even if it grows at a regular S&P rate, grows to closer to 4% in the space of 5 years. But for these products and the folk companies that we invest in, they typically grow faster than the S&P 500. So you could expect a greater growth rate in terms of your income than the broad market overall. So this relative superiority is just going to get higher over time. All this being said, maybe I want to hand it off to Steve Baumgartner, who will also talk about the nature of the product.
Thanks a lot, Doug. This is Steve Baumgartner. Mark and I, as of September, will be co-managing this dividend-focused portfolio for the past 6 years. And I want to touch on the high quality and relative safety of this portfolio. First and foremost, every single holding, and it's approximately 60 holdings in the portfolio, is rated investment grade by S&P. And 88% of the portfolio is rated high quality investment grade, meaning BBB+ or better. As you know, with the COVID-19 crisis, we've seen numerous companies cut their dividends. By my count, it's more than 65 large cap companies have cut or suspended their dividends since the beginning of March. That's approximately 13% of the S&P 500. Looking at the dividend-focused portfolio, we've avoided these pitfalls. We have not seen one company cut our dividend in the dividend-focused portfolio. So we've owned some of these companies that have cut their dividends, but we have been out of these stocks prior to them cutting their dividends, and in most cases, significantly well before those dividends were cut. As a matter of fact, since the beginning of March, we've seen 9 companies actually increase their dividend, and that average increase has been 6.5%. Year to date, approximately 24 companies out of 60 have increased their dividends by an average rate of 8%. And looking at the portfolio, 28% of the portfolio are dividend aristocrats. That compares to 13% of the S&P 500. If you don't know what a dividend aristocrat is, it's simply a company that has increased its dividend over the past 25 years or more. So that's a lot of tough times that the economy and the market has gone through, that these companies have been able to weather the storm and increase the dividend. As Doug pointed out, the current yield of the portfolio is around 2.7%. That compares to the 10-year Treasury at 0.7%. And we've seen dividend growth in excess of 7% over the past 5 years. We think that's sustainable over the long run. And that basically means that over a 9 or 10-year period, the amount of income you're getting from this portfolio is going to double, assuming that 7% growth rate holds. Once again, just re-emphasizing the safety, relative safety of this portfolio. We have a below market standard deviation, a below market beta, well below the market at 0.85. And we have a great downside capture history of 87%. What that simply means is if the market drops by 10%, historically, we have fallen by 8.7%. You probably saw that in that September through December of 2019 period, where we picked up more than 300 basis points of alpha. So we did even better than what we've done historically as far as downside capture goes. There have been 13 periods where the Russell 1000 Value Index has been down quarter over quarter since this portfolio has been live, and that's going back to June of 2008. In only one period did we materially underperform. So we have a great track record of outperforming in down markets. Our average alpha during these down markets is 150 basis points. So we like to say we participate in up markets and outperform in down markets. And while we don't want the market to go down, this is usually the period that we pick up a lot of alpha. And with that, I'm going to turn things over to Mark Batty.
All right, great, Steve, thanks. So yeah, if we could just stay on this slide, I want to focus primarily on some of the recent trade activity that we've done for the dividend-focused portfolio. One thing I would note, in a prior call we had with your organization, we did note, this was early on, in mid-March, we did a transaction, I think resonated well with a lot of people, and this will give you a feel for our thought process, again, in growing the dividend, avoiding companies that cut dividends. We sold a company called Darden Restaurants, which most of you know, they own Olive Garden, Capitol Grill, Seasons 52, et cetera. Well, given the COVID-19, the pandemic, the business shutdown, they were certainly going to be negatively impacted by that. Less activity, or not the ability not to go to restaurants for a long period of time. So we did sell Darden. This was in mid-March, and we purchased a company called Clorox Company. And as you know, the Clorox products are in high demand at this time and likely going forward. So we sold Darden, purchased Clorox, and the thinking there was risk to the Darden dividend, and we thought Clorox, strong fundamentals, strong ability to grow dividends over time. And that played out well for us, because shortly after we sold Darden, they did in fact suspend their dividend. And Clorox has been performing quite well since then also. So just wanted to touch on that trade. That was back in March. Now, some of the more recent transactions we can see on this page, on page 6. And I just aggregate some of the trades. So one big concept that we did was we reduced financials, specifically banks. So as most of you know, with COVID-19, the related business shutdown, many businesses, not small and large, have been under significant financial stress. And ultimately, that comes back to the banking industry that are holding those loans or have extended loans to whether it's a large company, mid-sized company, or a small restaurant, et cetera. So we've reduced exposure to companies such as Citigroup, Citizens Financial, Truist Financial, and basically we increased our exposure to companies in the information technology sector. So think companies such as Microsoft, Motorola Solutions, Broadcom, Intel. Again, companies in the current environment that are doing quite well fundamentally, actually thriving in this environment, good fundamentals, ability to grow their dividend over time. Whereas banks, as you know, currently now that they cannot increase their dividends, again, a ruling from the Federal Reserve, the recent stress test that was conducted in late June, banks cannot grow their dividend at this point in time. So again, as Steve and Doug both pointed out, we want to grow dividends in this portfolio over time. That's our objective, to exceed that of the S&P, the 7% number that Doug threw out. We want to grow dividends over time, and there's a big compounding impact to that, a positive impact to that, if we're able to achieve that and exceed that. And in fact, we have done that. So that's some of the thinking behind some of the trades that we've done. Also, within information technology, we've sold a company called Paychex, which is a payroll processor for small businesses, and certainly has been impacted by, again, the COVID-19, the business shutdown. Again, redeploying those proceeds into companies like Microsoft and Broadcom. So that, again, that's some of the thought process behind that. Also sold a company, Waste Management, which is a company that does poorly in a recessionary environment. There's less consumption, basically less trash that is volumes decline. So again, we redeploy that into a company such as Dover Corporation that's involved in refrigeration. So that's some of the thought process behind some of the trades. And then also, we've talked a lot about the quality, high quality nature of the portfolio. And I believe on page 8, there is a, I think not the next page, the page after this, if someone could move that forward. Just want to talk about some of the top 10 holdings. Most of these names will resonate with you. So Procter & Gamble, Verizon Communications, Bank of America, Honeywell, Amgen, actually 2 companies that were recently added to, or are being added to the Dow Jones Industrial Average, Amgen and Honeywell. So again, Lockheed Martin, Home Depot, Doug mentioned earlier as well. So again, all high quality, recognizable companies that can grow their dividends over time. And many of these companies, as I indicated, are doing quite well in this current environment. So just to wrap up, again, we've talked about the high quality nature of the portfolio. I think that's evident in what we've talked about, the top 10 holdings. Also, dividend growth is key for us. Again, we want companies that can grow dividends over time, and we've been successful in doing that. And then also at the end of the day is performance, investment performance, which has been quite strong over both the short term and the long term. So feel very good about it. Again, as both Doug and Steve talked about, the dividend yield 2.7%, above that of the benchmark portfolio of 2.4%, Russell 1000 value, and the S&P about 1.7%. And then as a fixed income benchmark, the 10-year about 0.69%. So again, attractive yield coupled with compounding of dividend growth over time has generated good, strong returns over time. So with that, just want to see if there's any questions around dividend focus, the dividend focus portfolio.
Great, thanks, Steve. This is Bill again. Hey, we'd love to hear from some of the city representatives out there if there are questions on some of the investment options. And in particular, we spent some time trying to highlight this because of the difficult interest rate environment where we could potentially allocate some of the funds into this dividend strategy. And we think it's worth looking at, but we want to make sure we answer questions. Anyone out there have any questions about the program or any of the investment options?
Bill, it's Jim Hamburg. Just real quick and whatever, maybe just go over 2 short-term, long-term funds. If folks have funds that are looking for short-term funds versus long-term funds or what have you, what type of recommendations would you all have, just as an example?
Great. Good question. So on the short-term side, liquidity and low volatility, I think are the most important things. And at this point, the options aren't fantastic in terms of the money fund. Yes, very liquid, doesn't move much in terms of the yield. At least right now, we're kind of stuck in a nearly zero interest rate environment. But if there are long-term funds, rainy day funds, road funds that are going to be used at some point in the future, but not in the near future, that's when we need to start looking at some of the equity options, either S&P 500 or dividend focus, or in the case of a city that wants more safety and more predictability, into the corporate bond funds. And those are the three options amongst the five that are newer based on House Bill 69. Mark, anything else to add on that front?
I don't think so. Stephen, if you move forward a couple pages, we had a couple of sample portfolios, but I would say, I guess, if you're looking at more of the short to intermediate and you really want to stay in fixed income, I would recommend a balance between the government bond fund and the corporate bond fund. I think that is a good complement to, say, your short money, which would be your CDs that you currently have, and any operating accounts in your banking accounts. But if you want to stay fixed income, an allocation between government bond fund and corporate bond fund would provide a higher yield and more diversification for longer term growth within that fixed income component. And if you get to the intermediate to longer term money, then that's when you would allocate some equity exposure into those portfolios. We believe, especially in this market environment, it makes a lot of sense moving forward for those longer term dollars. That's where the returns are going to be coming from moving forward here, given the starting point in the low interest rate environment and fixed income. I think cities should really be looking at where they can, incorporating some equity exposure to diversify their holdings. What you see here on the page is a sample of and more of a conservative portfolio. I would say 35% total in equity, 65% in fixed income, and utilizing the four funds. And you can see that, and this is based on our 10-year forward-looking capital market assumptions, that what our strategists believe for each of these various asset classes, what those average annualized returns are going to be over the next forward-looking 10-year period. So you can see this type of portfolio, again, and this would probably be more of a, a conservative way for intermediate to longer term money. About 4.3% average annualized return. And you can see down at the bottom the volatility. So, within a 1 year period, you could go from a high of 17% to a low of, say, 6.7. So that's where you need to, think through within your policies and your, if we're down 6.7 in 1 year, is that okay? We understand, what we're doing here and have a policy for the time horizon. You can see as the longer time horizon goes out, it's, the chances of losing money is less and less. And so that's a way to diversify, and we can help you structure other policies or allocations. Over on the next page is kind of the reverse of that, which would be more of a balanced type of portfolio, 65% in stocks, 35% in fixed income, more for the longer term bucket, where you could, you could get appreciation. You could take that appreciation to help support your short-term funding needs and that type of thing. But that type of an allocation adjustment, again, and I just put in a model of, using a percentage of between the two, and like say, 40% in the S&P 500, 25% in the dividend focus, 15% in government bond fund, 20% in corporate bond fund. About 5.6% average annualized return. You'd see, a little more volatility on the 1 year period, but, over time still, the longer, say 3 years out, the chance of losing money is a lot less. So these are just a couple of suggestions or samples of diversified portfolios that could give you something to think through. And we can also, like I mentioned, work with you to develop a specific strategy for all of your funds if you need something like that. Are there any other questions from anybody else on the call?
I can throw out a question that we get a lot, and it's related to the House bill, and some cities will ask, how much can I invest in these ways? And in terms of investing in stocks, cities are able to put 20% of their investable assets into stock market investments and another 20% in corporate bonds. And in terms of government bond investments, there are no limits, of course, but we just wanted to make sure everyone was aware of that. If you haven't read through the bill or if you haven't looked through some of the materials, those are the limits, but that enables a lot of cities to take advantage of this program to improve the potential investment outcomes. With those, even with those limits, there's a lot we can do within the program to help cities out in this really low interest rate environment. What other questions? Mayor Dira, for Mayor Hamburg, anything that you've experienced as being part of the rollout of the program?
I would say we're getting ready to put more investment into the program, but to be honest with you, we're kind of waiting to see how the election turns out, to see how our mixture is going to be, because it depends on who becomes the elected president. We feel could adjust this one way or the other and where we put the funds. Now, I think we're still going to put the funds in the investment pool, probably another $1 million or so, but it'd just be a matter of how we distribute it. And we're looking for 1st of November. We feel like both COVID and the election and other things that are going on in our community that you all live in maybe significantly less to where we can look and see what we're going to see in the future and where we should go forward with it. So our view right now is we have the funds that we want to move forward, but we're kind of just sitting, waiting to see what the future is in 2 months.
Yeah, and I would also agree with what Bill was saying. I think too, going back to what Bill and Mark and all have said, I think overall that this is an investment pool that gives you all an option to take a look at something different than just going down the bank, down the street and getting a CD. I think these gentlemen are well versed. I think you can see that as a fiduciary portfolio managers, they can decide or help you decide for you or with you as to where the best place is to place your dollars for your taxpayers. And obviously that's the main key here is how and where are we going to place dollars to be able to get a significant return. I think that's what this is all about, really, when you take a look at this, what the KLC's done with the House bill to bring this forward on 69 to be sure that this happens for all of us. So they do act in a fiduciary manner. PNC does, which means that they have the responsibility to safeguard those funds. If there's any downturn or anything that goes on, I will tell you that these gentlemen do give a call back to you and do make a request that maybe you consider an alternative investment. So guys, I don't know if you want to speak to that or not, but just want to mention that too as well.
Jim, I'd also like to say that from Mark's presentation on where they moved stocks during the height of the drop, was very significant to save this portfolio from going down. So I compliment them, because a year ago when we were all sitting around trying to get people to be involved, to now it shows what PNC has and why we picked PNC to be the person to watch after our funds, because you all did a fantastic job during the fastest drop in the stock market to protect our funds and make sure that we came out of this as quick as possible. So I have to compliment you all on how you went from restaurants to Clorox and saved the funds that were in there and actually grew them at this point in time. So thank you for that. Thank you for protecting our funds.
Amen on that. That sounds good.
Anyone else? What questions can we help with?
would ask anybody else that's from the other cities what they feel like their strategies are from now to the next several months. Does anybody have a thought process? Because this is a pool of all of us, not a pool of one of us. So if you have some thought process, that's how the stock dividend fund came about, through us visiting cities and them ask us to invent that silo. So this is a point in time that if you feel that there's a certain methodology that you see in the future, it very well could be something that all the cities could join in on.
I'll throw out one more other question that Mark and Kevin and I get quite a bit is, well, it's less of a question and more of a point of interest. When a CD matures that was maybe put in place 1, 2, 3 years ago, and that's when we're hearing from cities is typically when they go out to the market and look at the other options and realize that you could park your money in a CD for 10 basis points. It's not that exciting, and that's when we usually start the conversation, and that's sparked several conversations over the past few months with cities who have had CDs maturing, and they're looking for options. I mean, this is a tough environment. We realize that a lot of city budgets are already stretched, and tax revenues are probably headed down slightly in this environment, and this is a way we can potentially help. So we're here for everyone on the phone and cities across the state to help with investment options and take advantage of the House bill that was put in place, and we're off to a great start, but we think we can really do a lot for you.
And another key, just to reemphasize what I said at the beginning, I get this question a lot, and I think it's really just where cities and administrators are comparing it to CDs and what they're used to. But there is no lockup period. There's no limit on the number of transactions that you can initiate. There's no minimum. There's no cost to open an account. So it truly does give you that flexibility to invest money, to park funds, to establish a policy and a program that you can relate to your council, to your community, that you're investing this money in a prudent way, and you're making adjustments given the economic environment that we're in, and looking at whether it's long-term money, short-term, and really analyzing how you can invest, manage the risk that you're taking, but get the greatest return of the city's money. So I just wanted to, I get that question a lot, of the lockup period and that type of thing. And it's really just the funds are valued daily. So if you call us and say, hey, we need $10,000 out of the road fund, then we're gonna send you that money directly to your operating account that we have on file. And the longest that it would take would be a 3-day turnaround if we just needed to sell money out of the market. So it's liquid, you have it available. And, like I said, I just wanted to reiterate that because I get that quite a bit in regards to lockups and things like that.
That's a great point. If there's nothing else, Steve P., we can kick it back to you to close up.
I think that was a great session, gentlemen. We can't thank you enough for, as Mayor Deere alluded to, your expertise. It's definitely a benefit to have such a broad group of gentlemen that know the market backwards and forwards to help guide our cities through the next 3 months and through election and then thereafter. Obviously, we had a session today to address any questions you all may have, but if there are still additional questions that you have or would love for either KLC or Mark or a combination thereof to come out to your city to address on a face-to-face basis, we would welcome that opportunity to help broaden your all's tools. But I won't banter on anymore. I think we're going to finish a bit early to give 5 minutes back to your all's busy days. So thank you and enjoy your Tuesday morning, soon to be afternoon.
Thanks, everybody.
Thanks so much.
Appreciate
Thank you.
Thank you.
Thank
everyone.
you.
Thank you.